Are you a potential home buyer who has had your affordability affected with interest rates going from 3% to 6% to a point where you're now sitting on the sidelines wondering whether or not you should pull the trigger and buy a home? Well, in today's video, I want to walk you through a strategy, a conversation that I'm having right now with sellers whose properties are sitting on the market, and how, as a buyer, this might benefit you not only in getting the home for less money, but also being able to walk away with a lower monthly payment. Now, if you're one of these home buyers who's been in the market for months, you know how much that increase in interest rates has affected your affordability. Maybe you were looking to purchase a $500,000 home just 5-6 months ago, and now it's a $350,000 home because of how much your payment has adjusted. Well, this strategy will allow you to still purchase that $500,000 home, but you have to understand how it works in addition to being able to negotiate it as a buyer. And that's what we're going to walk through in today's video. But before we do that, I want to take a minute and ask a favor. If you find any value in today's content at all, hit the thumbs up and also leave me a comment below. Have you used these strategies before? If not, what do you think about them? And if you have used them and they've worked or haven't worked, I'd also love to hear your thoughts on that as well. So do me a favor and leave a comment below. Now, when it comes to purchasing a home, most buyers are thinking about the purchase price and they're thinking about their monthly payment. And typically speaking, as homes sit on the market a little bit longer, buyers believe that they can come in and offer less money for that property. But at the same time, we know that can be tough, right? Because sellers always believe their homes are worth more money. So what is the middle ground? What is the compromise in these situations? How can you come away both as winners? Well, that's what we're going to talk about right now with this strategy. And this strategy is using the seller's money to buy down your interest rate so that you walk away with a lower monthly payment. And this also benefits the seller because they can get away with giving you a credit to lower your monthly payment, which we'll talk about how this works in a minute, which is going to end up costing them potentially less money than lowering the purchase price. Now, as a home buyer, you always want a lower purchase price if possible. But at the same time, if you can get away with a lower monthly payment, that is the number that you remember every single month. That's the number that really matters, because that's the payment. That's the amount that you need to come up when you make your monthly payment. In my experience of nearly 20 years in this business, home buyers care more about how much the payment is versus how much they're paying for that property. If I told you today that you could buy $1 million property and it would only cost you $1,000 per month, do you really care that it's $1 million property? Or do you only care that it's $1,000 per month? In my experience, home buyers care more about the monthly payment. But we're going to walk you through how this strategy works right now so that you can decide whether or not it's the right strategy for you. Now, as I mentioned a moment ago, we're going to talk about using the seller's money in order to buy down your rate. Now, you might be thinking, how does this work? What is a buy down on a rate? Well, let's take a minute here and explain that first. So when you get a loan, you get an interest rate, if you will, right? That is something that you're being quoted as part of the pre-approval process. And something that you're able to do as a buyer is actually pay money to the bank and actually buy down that rate. So in the case that we're going to talk about today, we're going to talk about today's interest rate being around 6% for most well-qualified buyers out there. But what if you could walk away with a 5% rate by having the seller pay some of the cost in order to buy down that rate? How does that affect your monthly payment? And how does the seller end up winning in this scenario? Let's say, for example, I'm a listing agent that has a property that's been sitting on the market for a couple of weeks. Now, I want to be clear in how this strategy works, that typically speaking, if a property is just coming on the market, it's going to be difficult to get the seller to participate, right? Because sellers want to gauge the market. They want to see what the market will bear. And if a property is just coming on the market, having them pay money towards your buy down of the interest rate might be difficult. It might work, but this is typically going to work better for properties that have been sitting on the market a little bit longer. So just to be clear with that. So let's say I'm a listing agent that I have a property that's listed at $500,000 and you as a buyer are coming in to buy that property today. And let's just say you're getting a $500,000 loan amount for purposes of this video. Now I realize that means that you're not putting any money down and you're buying this property, which isn't realistic, but I want to use $500,000 loan amount for this video so that I can go over some numbers, and then we'll also talk about a $750,000 loan as well, just to give you an idea of how this buy down and rate works and how much it impacts the monthly payment. So if you're a buyer, you go in today and you're able to get a loan, $500,000 at a 6% interest rate, which is essentially where rates are today for most well-qualified buyers out there. Your payment would be $2,997 per month. Now, as a listing agent that's got a property that's been sitting on the market for an extended period of time, I'm already having conversations with the seller about potentially reducing the price of this property in order to keep up with what the market's doing and just to show the market that, hey, we are serious as sellers. So we're already having the conversation about potentially reducing the property value in this case, right? With the listing price. And where something is priced about $500,000, I would probably suggest reducing the price to somewhere around $475,000 on a $500,000 property, which is a $25,000 reduction in price. That means the seller would be netting $25,000 less on that $500,000 purchase price in this case. Now, you as a buyer, your goal is to get the property for less money, but your goal is also to pay less money per month in order to purchase that property. And if you can get the seller to buy down the interest rate, in this case, from say 6% to 5%, not only does it benefit you with a lower monthly payment, but it also benefits the seller because the seller doesn't have to reduce the price by $25,000. In this case, they would only be reducing the price by $15,000. Why? Because what you're going to do as a buyer is ask the seller when you're writing the contract, to purchase the home, you're going to ask the seller to pay for 3% towards your closing costs, which is going to allow you to use that money to buy down the rate. And in today's example, you're going to be able to use that 3%, which is $15,000 on a $500,000 loan amount. You're going to be able to buy your rate down from 6% to 5%, which is going to take that payment from $2,997 to $2,684, which is a difference of $313 per month. And you might say, well, Jeb, how is the seller winning in this example? Because they're paying $15,000 for my closing costs. Because as a listing agent, instead of suggesting to the seller that we reduce the price by $25,000, I'm putting in the seller's mind that we should start to consider doing things like helping buyers buy down the interest rates in order for the buyer to be able to take advantage of a lower monthly payment at no cost to them. And you might be saying, well, Jeb, why don't I ask for more than 3%? Why don't I come in and ask them to pay 5% towards my closing costs and buy down the rate even more? That's an option, but you've got to have a seller that is willing to work with you. In the example that we gave a moment ago, 3% less than the purchase price on a property that's been sitting on the market for an extended period of time is not really that big of a price reduction. But as a listing agent, I've also got to be able to convey to the seller that it's a benefit to them in this market as well. So in this case, all we're doing is using the seller's money to benefit you as the buyer by buying down that rate. Now you might come in and say, well, Jeb, I'd rather have the $25,000 less on the purchase price than I would then buy down my rate. Well, if we did that same example, your payment, instead of being $2,997 on a $500,000 loan amount, your payment would be $2,847. So by reducing your loan amount or the purchase price by $25,000, you're only saving $150 per month. Whereas in the case that we asked the seller to buy down the rate, you're saving $313 per month. So you're saving double the amount by keeping the purchase price at the original purchase price and just asking the seller for a credit. Now you might be asking yourself, well, Jeb, why can't I just buy down the rate myself? Why do I need the seller to buy down the rate? Well, you don't need the seller to buy down the rate, but it's a benefit. If the seller pays the fee, then it's less money that you have to come up with out of pocket. And when you decide to buy down the rate, or if you decide to buy down the rate, anytime you pay discount points, that's a sunk cost. You never get that money back. So at some point in the future, if interest rates creep down and you're able to refinance, you can take advantage of that refinance without having to think that, I paid this money just a couple of years ago to buy down the rate, and now I'm refinancing, which is basically a wash with the money that I initially paid down. Whereas if it's the seller's money that you're using to buy down that rate, you're not really going to have that consideration because it was never your money to start with. So I wouldn't consider doing a buy down with my own money in this market, just because at some point in the future, I do think interest rates are going to go lower, but you can't go in buying a house with the expectation that that's going to happen. It's one of those things that's nice if it does happen, and it's a lot nicer if the seller has already bought down your rate, where you don't have to worry about refinancing if interest rates go lower, because you don't have any additional skin in the game like buying down those points. In addition to that strategy, another strategy you can do in this market to potentially save money is go with an adjustable rate mortgage. Now, adjustable rate mortgages are not for everyone. There are definitely pros and cons to adjustable rate mortgages, which I've gone over in another video, which I'll link to here if you want to understand them in more detail. But in this case, I want to talk about the idea of getting the seller to buy down your rate and also using an adjustable rate mortgage at the same time to see how much money that can save you per month. So in the example that we were talking about a minute ago, I was primarily talking about 30-year fixed mortgages. But what if you went from considering a 30-year fixed mortgage, in this case, at a payment of $2,997 on that $500,000 purchase price, to using the seller's money to buy down that rate, say 3%, and using an adjustable rate mortgage? Well, in today's example, you can actually go from a 6% interest rate to somewhere around a 4% interest rate for a 5/1 ARM, which could allow you to walk away with a $2,387 payment per month, which for those of you keeping track is over $600 less per month than if you had gone with the original purchase price on a 30-year fix. So in this example, you're using the seller's money to buy down the rate 3%, but you're buying it down and going to an adjustable rate, which allows you to save way more money per month. Now, I want to be clear, this isn't going to work in every case. As I mentioned earlier, you've got to have a seller that is willing to work with you. You've got to have a listing agent that understands how it works. And you, as a buyer, also need to understand how it works as well. And in some cases, it may not be the best deal. Maybe they're only willing to give you 8% or 2%, but it all comes down to negotiation and having an experienced real estate professional as well as an experienced mortgage professional on your side. Because if you do get the seller to work with you, you've also got to have a mortgage professional that understands how to put that loan together and be able to explain to you how that buy down works so that you can see it on paper. Now, you can also use this strategy with new construction. It's not just on existing homes. Builders are willing to do these sort of things as well, especially in a market that's changing, because they're looking to sell properties. They're looking to get more creative. And the same can be said for sellers in this market. As more inventory comes, things start to sit a little bit longer. Sellers are willing to entertain things like this. And maybe you don't want to use the money for the buy down of the rate. Maybe you just want to have your closing costs covered. Whatever the strategy is, just make sure you have a professional real estate agent, professional lender on your side. And if you need one of those, I'll throw a link up here on the screen where you can go, and be referred to an expert that I know, like, and trust, someone that will guide you through that process. Now, if you listen to this video and this made sense to you and you're considering using an adjustable rate mortgage, you just want more information about how adjustable rates work, do me a favor, check out this video here. I dive into it in more detail to help you understand the pros and cons. But for now, I appreciate you taking the time to watch. I appreciate your support. Hope to see you again soon. Have a great day. Bye-bye.